welcome everyone. Thank you. First, Andrew and I both want to say thank you to the University of West Florida, School of Business, Fannie, and the Maygarden family. Thank you very much, because without the most generous gift that you all did, we will not be able to do this evening. And Andrew and I both spoke about this. Financial literacy is now more important than ever. If you look around today, we have $22 trillion in federal debt. Student loan payments that, again, many graduates are not able to maintain paying. We have people who have car loans they're not able to make. And just, trying to rein in spending that people have and they've done, and making sure that they save is just very, very important. Because, again, you want to make sure that you're able to get to the end of the rainbow and enjoy your wonderful path to retirement. So with that, some ground rules. Number one, okay, we're here to have fun this evening. Okay, very, very important. Enjoy a little nosh. That's number one. Number two, there is no silly question. Bless you. There's no silly question. Okay, if you have a question and we're not able to get to it, please write it down next to your survey, because this way we'll make sure we touch on it. We're going to be around. We're going to stay here as long as need to this evening, all right? So that's that. So we talked about having fun. We talked about no silly question. And really, to kick this off, Andrew and I want to get your ideas of what you think is a four-letter word. Now, we have to keep this G-rated, okay, a four-letter word that will have a tremendous impact upon your retirement. What four-letter word do you think will have a tremendous impact upon your retirement? All of our retirement. Huh? Safe, okay. What else? Cash, all right. Plan. I didn't even think of these. Are great. And look, I'm doing this 40 years. Great. What else? Another one? Wife. Okay. All right. I'm not, exactly. All right. What else? I'll give you a hint. Okay. The word starts with an M. Huh? More? Okay, we all want more, and ends in an H. Math. Who said math? Okay, you get a gift. So this is for you, okay? So congratulations. The word is math, all right? Let me mention why the word is math. Who? Not boo. Who? That's boo. Who? Okay. All right. The word is math. And if you want, you can write these down or not, but let me go over some of these numbers. And in fact, the discussion was maybe these are the right lotto numbers, including the Powerball. I don't know. Wouldn't that be a funny thing? But there we go. Wouldn't it be interesting? So of all of the money that comes into the federal government on an annual basis in tax revenue, 62% goes to federal entitlements. Now, I'm not making a political statement or anything like that. That is the truth. Medicare, Medicaid, Social Security, 62%. 8% goes to pay the interest on the federal debt. Now, here's the thing. This is not the principal on the federal debt, okay? This is just the interest. I'm going to jump over here for a second to number 22. Now, there's $22 trillion in federal debt right now, and by the end of the year, this year, we're going to add another $1 trillion in federal debt, because the difference between what we're spending, $4 trillion a year, and we're getting in, and thank you, I'm watching the doctor shake his, yeah, okay, we're getting in about $3 trillion a year in revenue that's going to add to the deficit. Now, I have a question and another prize. Okay, here we go. How many times around the moon, if we stack up 22 trillion $1 bills, okay, will we be able to go around? Okay, I got to write the numbers down because so 7, we'll get to whoever's closest. Come on. How about this side of the room? 70, okay. 1,000. I'm getting depressed listening to this. Go ahead. Anyone else? 5? 35. 36. This is like the Price is Right here. Where's Bob Barker? Go ahead. 15. So I'll take one more. 2. Okay. Sir, you are right. You get a prize. It is 2.5 times. So congratulations. You would pass that back for me, please. Thank you. It is 2.5 times. If you stack up $22 trillion, how many times we'll be able to circle the moon? All right? So think about that debt. It's a lot of debt. Now, let's finish up here. The next number is 15. 15 cents of every dollar goes to pay for our military, both the folks that have proudly served our country, as well as everything that we have that goes along with that today. And for those of you who are veterans, thank you very much for your service. The last 15 cents of every dollar that comes in, that goes for everything else, including infrastructure, education, health and welfare, etc. Now, if you remember nothing else from the talk that I give this evening, from the time we get to spend together, and why it's so important that you're here, I'm going to circle this number 7. There's a story in the Bible where they talk about 7 years of feast and 7 years of famine. There was a new tax law that was passed last year. The tax law lasts, guess how many years? 7 years, okay? The tax law sunsets 12/31/2025. Now, at the end of that period of time, if Congress does nothing, absolutely nothing, everything that was set up in the tax laws reverts back to what it was prior in 2017. Now, I don't know about any of you in here. My lovely bride, Marcia, who's sitting in the front row, and I think are going to end up paying a little more than we did in 2017 for a few reasons. We've been blessed to work with wonderful people, and we earned a little more money, okay? But also, too, because of the change in the tax structure, all right? So here's the thing, though. Everybody in here, okay, gets a $12,000 standard deduction. So one of the things that Andrew, my partner here, who was voted best of the Bay as far as investment managers here in Pensacola, is going to talk about is there is one investment. And again, we're not here pushing any product. We're just talking about concepts. But one investment, okay, that you really should look at, especially with the fact that you get a coupon that you can use. And he'll talk about that in a little while. All right? Because here's the thing. This is a gift that we have. So as they say, during the 7 years of feast, put away the grain, okay? Do the planning that you need to do. Sit down with your financial advisor, talk with your husband, talk with your wife, talk with your friends. But don't just sit back and let things go. Because here's the thing, folks. The debt's going to keep increasing, all right? And another point that I want to mention, and here's a sine wave. I'm not the best of artists. If you look at the situation, and if this is the time for baby boomers, all right, and I just had my 60th the other day, so I fall into that realm of my wife is smiling, okay? I had a great birthday, by the way, okay, of baby boomers, is that interestingly enough, in a question, when does everyone in here who at some point will be retired, got it, thank you, have to start taking their money out of their IRAs? What age? 70 and a half. You have to start taking your required minimum distributions actually by the April 1st following your 70 and a half birthday. So interestingly enough, this tax law is set to sunset just at the particular time when the majority of the baby boomers are going to hit that wonderful April 1st following the 70 and a half birthday. How do you like that? Interesting. So Andrew, again, is going to talk about what are some strategies that you can do to make sure that you're able to keep your require minimum distributions down, which is going to allow you to pay less in taxes. Because here's the thing, and again, we save throughout our working years, and we get to the top of the mountain, we want to make sure that anybody in here ski ever? Okay. You want to make sure that you have a nice slalom, nice easy way down the hill, okay? So it's really not, and you don't spend your assets, you spend your income. So it's incumbent upon each and every one of us to make sure, yes, we're doing all the right things that we need to do, number one, okay? But number two, we want to conserve the assets and set the income up so that when we do retire, we have as smooth a ride as possible, okay? Did anyone in here ever fly through a thunderstorm? It's not a lot of fun, is it? We just went through a thunderstorm in the financial markets over the last month and a half. It wasn't fun. Now, we've come back a long way, but who knows what the situation is. So again, you want to make sure that you've insulated yourself as much as you can, especially as you get closer and closer to those retirement years, so that you, A, don't outlive your money, and B, become dependent upon anyone else, okay? I left one number out, and that's the number 6. Let me explain what that is. From the time our country ratified the Constitution in 1789 to now, I don't know what's going to happen this year, but to 2018, the blended rate on long-term federal debt, believe it or not, has averaged 6%. 6%, all right? Now, I want to see just show of hands. Bear in mind right now, the average interest rate on U.S. Treasury securities, because again, all the central banks around the world, they talk to each other, and I understand that some members of the faculty went to a Federal Reserve meeting today, okay? And you can ask the question, but right now the blended rate's probably about 3%. Other than times of extreme financial stress, I was taught, because I'm here in Pensacola and married to a Southerner, I have to call it the war of northern aggression, okay? All right? I got a laugh last time. You guys are tough, okay? All right? All right? In World War II, did we ever have such a high amount of debt in terms of our GDP as we do right now? And here's the thing. How many people in here have ever lent money to a person? Okay. And hopefully we all got paid back, all right? If you, in talking with that person, if they were in a situation where their word was their bond, and by the way, that's where the word bond comes from, the word was there, and they paid you back, great. But would you be concerned and maybe charge them interest or a higher rate? Thank you, miss, yes, thank you. What's your name? Charlotte, thank you, Charlotte. Yeah, you'd want to charge a higher rate of interest if all of a sudden you didn't think you're going to get paid back. So just a silly thought, all right? If we just get back to the average interest rate on federal debt, if nothing else increases, if no more baby boomers retire, that's not going to happen, okay? I'm not even going to go here, but if no more baby boomers retire, we know it's not going to happen. But if we just get back to the average interest rate on federal debt, that 8 is going to go to what? Okay, hold it, 16. You get the last prize. Here you go, sir, okay? It's going to go to 16. So before, when we were paying out, that's for you, thank you, $1 on $1, something's going to have to give. Either the government's going to have to print more money or they're going to have to raise what? Taxes. And don't you think it's interesting where this sun sets? So again, for those of you who are going to be retiring over the next few years, I would really take a real strong look and listen to everything that this gentleman, who was voted one of the best financial planners in Pensacola has to say. So with that, any quick question? Yes, sir. Well, and I agree with you. And if we look at empires, and again, one of the things, the reason why I got to speak at the Museum of American Finance is I also enjoy collecting coins. And I made it a study to look at countries through history. And if you look at major empires, the Roman Empire, the British Empire, and look, our republic is an empire too. If you think about it, and I appreciate the question, we can continue to debase the currency. At some point, though, something's got to give. It used to be, now I'm old enough to remember, because I used to deliver the newspapers, that when our money, anything higher than a nickel, had what in it? Silver, right. Now, it's really rare, and maybe I'll come across and I'll find a silver diamond, I'll run up and say, hey, Marcy, look what I got and changed it. You know, it's true. I'm 60, I still get excited about stuff like that. But absolutely, we can continue to debase the currency, but what do you think is going to happen? At some point, we're not going to be, and here's the other thing, and I'll be real quick, and I appreciate this, because I want to make sure Andrew's got plenty of time to talk about all the good things he's going to do tonight. All right? We are very blessed here in the United States for many, many reasons. We are the reserve, since Bretton Woods in 1944, we are the reserve currency of the world. Everything's based, not everything, but gold is based in dollars, oil is based in dollars, okay? There's several countries around the world who are saying, you know what, we want to change that. Well, if that happens, our standard of living is going to, yes. So I agree with you. We could continue doing what we're doing and staying on the path. I hope we don't. Sir. What's your name, please? Phil, you're doing a great, are you here at the university? We got to get this guy in adjunct position. No, I appreciate it. You're absolutely right. And this is what's happening. And this is why we're so very concerned, because again, I think that we've been lulled into a false sense of security because of this. And this is a train that's coming down the track, ladies and gentlemen. And at the end of 2025, mark my words, and hopefully they'll have us come back, but we don't have a lot of time to do planning, because something's going to have to give. I don't know what it'll be. Thank you, Phil. Other questions? All right. Andrew, I'm going to give you this, and the floor is yours.
So to go off what Larry said, and thank you, Larry, for everything that you discussed with us there. We're going to be talking about some very timely information this evening that I hope, if nothing else, just gives some good information. Take this back, use it if you're a do-it-yourselfer. Take it, and hopefully you can apply it and use it for your own retirement planning, or if you use a financial advisor, take it back and talk to them about it. Just to reintroduce myself, I am Andrew Martin, founder and president of Atlas Financial Strategies. Larry is too humble to brag on himself, so I will do it again. See the alphabet soup behind his name. He's a very, he's a wealth of information. Look at all the, he's a very talented writer. He's been covered in a lot of different publications. So Larry has decades of, years and years of doing this since before I was born. So thank you, Larry, for sharing your knowledge. I am apparently not too humble to brag on myself. So I've been in the business since 2011. I've been voted best financial advisor a handful of times here in Pensacola. Again, I've qualified for the $1 Million Roundtable. Nobody outside in the industry typically knows what that means. That just means that recognizes a financial professional as part of the top 1% of financial professionals in the world. Some disclaimers here. We're not here to sell you anything. We're just here to give you information. So again, what we're here to talk about this evening are 5 main challenges that most pre-retirees or retirees face. The first one, of course, is cost of living increases. Everything gets more and more expensive as the years go on, as I'm sure we are all painfully aware of. So how do we plan for that and mitigate that? Outliving your retirement savings. This is a big one. Retirees' biggest fear is outliving their retirement savings. So how do we make sure that our money lasts as long as we do? Oh, excuse me. 3, taxes, a thorn in all of our sides. as Larry was just talking about. How do we reduce taxes? 4, expenses. There's a lot of expenses that are going to be new to you in retirement that you did not have the challenge of facing before retirement. 5, expectation versus reality. I'm sure we all can appreciate that sometimes we expect things to go certain ways, and then there's a way that they actually happen. So the first one, challenge number 1, inflation and market risks. So like we talked about, everything gets more and more expensive as the years go on. So our money has to grow to at least keep up with inflation. The best way to make your money grow to keep up and outpace inflation is by investing in the stock market. That comes with a slew of risks. How do we mitigate those risks? So that's something that we'll discuss heavily this evening. So you can see over the last decade or so, inflation has been pretty muted. It's been pretty low. Has anybody remembered decades ago when you could get a CD for 12, 13, 14%? What are CDs paying now? Yeah. Right. You did good finding one that paid 3%, right? So not much. So inflation has been fairly muted. It has started to pick back up, but we don't necessarily expect it to remain this low for too terribly much longer. Yes, sir. Oh, of course. Of course. Oh, of course. Yeah, I mean, the cost of college, let's say, has gone up, faster than the CPI. So there are, different inflation costs that apply to different things. So that's a great point. Thank you. I will say the long-term CPI, the long-term average inflation rate is 3.24%. That's what this chart is showing you. So it shows you $500,000 in 10 years. It would take $688,000 to have the same purchasing power of what $500,000 would have purchased you 10 years earlier. In 20 years, it would take almost double. It would take almost $1 million to purchase, based on a 3.24% inflation rate, to have the same purchasing power of $500,000 20 years prior. So, again, one of the best ways to outpace inflation with your money, because if you're not outpacing inflation, you are losing money. So if you have money in the bank getting 0.02% return, and inflation is, let's just keep things simple, 2%, you are actually losing almost 2%, 1.98%, because the purchasing power of those dollars are not keeping up with inflation. So investing in the market is one of the best ways to outpace inflation, but that comes with a host of risks. So if we are, has anybody heard of what's called sequence of returns risk? Sequence of returns risk? Okay, I know you know, yeah. Sequence of returns risk is something that most people are not, have not heard of or are not aware of, but it is something that can, completely disrupt an otherwise good retirement plan. And so we'll look at the numbers here, but the point is, could early losses in retirement, so if you were to retire in the next couple years, so who here thinks, when was the last time we had a recession? 2008. So it's been 10 plus years since we've had a real recession. Do people think that we are in the bottom or the top of the economic cycle? Top. Where do we go from the top? Okay. So would it make sense to say that potentially in the next handful of years that it is very likely that we could have some sort of recession? Probably so. Now, we don't know. There's a lot of factors, and we'll get further into that tonight. So sequence of returns risk, this goes over sequence of returns risk during your accumulation years. So in other words, during your pre-retirement years, those years that you are saving for retirement. So sequence of returns risk does not exist during your pre-retirement years. And I'll show you those numbers. So this is one of those challenges that are going to be new to you in retirement. So can anybody see the red dot here? Everybody see that? Okay. So you see here in Portfolio 1, you can see so this looks at the S&P 500, which the S&P 500 has long been held as a benchmark of the stock market. So that's when most people say stock market, they're usually talking about the S&P 500. So that has long been held as a benchmark of the stock market. So this tracks the S&P 500 from the year 2000 to 2016. So this shows you in the early 2000s, you had 3 straight years of losses. That was the tech bubble, if anybody remembers that. Negative 9%, negative 11%, negative 22%. Then we had gains. Then we had that big one, 2008. Everybody remembers that one. And then we've had gains since then, up until last year. So this assumes you started with $100,000 and you're just letting your money grow. So over this 16-year period of time, the S&P 500 averaged a 6.2% return. And at the end of that 20 years, as long as you were not pulling money out and you were just letting your money grow, you ended that period of time with almost $212,000. Now, Portfolio 2, what we have done is reversed the sequence of your returns or the order in which you have received those returns. So we started with the year 2016 and went in reverse. Does everybody see that? So you can see here, instead of 3 straight years of losses, we have gains to begin with. And then we have 2008 right here. And then we had 3 years of losses there at the end. Again, this portfolio averages is a 6.2% return, and we still end with an almost $212,000 portfolio value at the end of that 16-year period of time. So sequence of returns, in other words, the order in which you receive those returns, mean nothing in retirement. Mean nothing before retirement. Now, in retirement, as you start pulling this money out to use and spend in retirement, sequence of returns means a whole lot. So, this is the exact same portfolio as the S&P 500, exact same exact same from 2000 to 2016. We start with $100,000, except now we're pulling out $5,000 a year plus a 3% cost of living adjustment. So every year we are pulling out 3% more than what we pulled out the year before. So we start with $100,000, we're pulling $5,000 plus a 3% cost of living adjustment out. At the end of that 16 years, we are left with negative $3,600. So we have outlived our money in a 16-year period of time. Sir? Well, yeah, hopefully you had somebody to borrow the money from. So portfolio 2, exact same thing. S&P 500, except again, we have flipped our sequence of returns. We have, in other words, the order in which we've received our returns. So we started with the year 2016. Start with $100,000, pulling $5,000 a year, plus a 3% cost of living adjustment. Both portfolios average a 6.2% return. Except with this portfolio, you outlive your money in a 16-year period of time. With this portfolio, you still have $97,000 in there. Can anybody guess why? Pardon? Right. So over here you had early losses, or over here you had early gains. That's exactly right. Yes, sir. So as you can see right here, this portfolio, this shows you the year by year what's left in the portfolio. Besides that first year, besides that first starting value, you never break 100,000. Over here, you never get below 100,000 until that very last year. So in other words, most people's plan is to retire. They have their money invested in their 401k or IRA. And their plan is to leave it invested and pull money out of it per month or per year as they need it. Now, if that is your plan, you're basing your entire retirement plan on luck. Because you might be lucky and retire, and in your first 5 years of retirement, you don't see any losses and you have gains. So that would put you in this category, hopefully. Or you retire and we have some losses in the first 5 years of your retirement, which would put you in this category. All right, so your entire retirement plan is predicated by luck. Now, like we talked about, we have not had a recession in at least 10 years. We think that the economic cycle has already peaked. I think most people believe that. I think that most people believe that in the next handful of years, maybe the next 1 to 3, that we will have some sort of recession. So if you have recently retired or your plan is to retire sometime in the near future, and your plan is to leave your money invested and pull it out per month or per year as you need it, do you think it's very possible that you could see early losses within the first 5 years of your retirement? So how do we mitigate that? We'll get in that discussion in just a minute. Challenge number 2, savings withdrawal rate and longevity. So how much money, if we have our money invested, how much money can we safely pull out and feel assured that we will not outlive our money? Longevity is a good problem. We all hope to live a nice long life. But the longer we live, the longer we need our money to last. So, I'm going to move this, Larry. So when it comes to withdrawal rates, we have to strike a balance. If you pull out too much, you run the risk of outliving your money. If you're not pulling out enough, well then are you really having the retirement that you worked so hard for? Right? We didn't work hard to penny pinch, we worked hard to enjoy our retirement. So consider this, people are living longer, and how will that affect your retirement? Did you know if you retire at 65, you have a pretty good probability of living to 86. If you live to 86, pretty good probability you'll live to be 93. 1 out of 4 people, 1 out of 4 65-year-olds will live past 90, and 1 out of 10 will live past 95. While that is wonderful news, that just means that is that much longer that we have to make our money last us. So, surviving the loss of a spouse. Income is everything in retirement. It doesn't matter necessarily how much you have, what your nest egg size is when you go to retire. What matters is how much income you have coming in when you go to retire. Income is king in retirement. So, it's very important that between husband and wife, if you have a pension, it's very important to understand what the survivorship options are on those, and Social Security. The survivor gets to keep the higher of the 2 Social Securities, but not both. So you will lose income in retirement, if nothing else, based on Social Security, upon the passing of a spouse. Challenge number 3, as Larry covered very well, taxes. Rollovers, long-term capital gains, required minimum distributions. So a common misconception is that when people move or roll over their money, that there will be taxes. We'll talk about that. Long-term capital gains instead of short-term capital gains is a way to reduce your tax burden. And then as Larry talked about, required minimum distributions at age 70.5, which we will get into further. So tax deferral is not forever. So if you've been making pre-tax contributions, tax-deductible contributions to your retirement plan, you got to write off or not pay taxes on your contributions. That money was allowed to grow. And then when you pull it out in retirement, it will all be taxed as income as you pull it out. So like we talked about, do we believe taxes are going up or down? If you believe they're going up, especially after year 2025, would it make sense to do something about that while we know taxes are going to be lower? Or do we wait to pay the taxes until they're potentially higher? Rollovers. So again, common misconception is that when you move money from a 401k to another type of retirement account, an IRA, or even if you move IRA from one company, you're upset with the management of whoever it is that you're working with, or you just haven't had it with an advisor and you want to move it with an advisor. There are no taxes and penalties. You're just changing addresses. You're just changing it from one company to another. As long as you keep the same tax status, there's no taxes. So you can move it over with relative ease. It's very painless. Rolling it over to an IRA, 9 times out of 10, it makes more sense to move your 401k or 403b or something like that, 457b, to an IRA. The reason is, the 1 out of 10 times it makes more sense to leave it, let's say in a 401k, is if you had some sort of stock options or something that you would be losing by moving it. But that is not the case for most people. So the majority of the time, it makes more sense to move it to an IRA as opposed to keep it in a 401k, because a 401k, 403bs, are inherently fee heavy. So there's fees that they have to tell you about and fees that they don't. Also, they limit your investment options. National average or for investment options within a 401k is 18. So an IRA would give you an almost unlimited amount of investment options. And then if you leave it with your provider, whoever your 401k is with, you probably don't have anybody managing it for you. In other words, nobody's going to call you and say, hey, this is what's going on with the economy or the stock market. We think it might be worth making some changes to hopefully mitigate some risk or, capitalize on an opportunity. So by moving it to an IRA, you're typically going to pay less in taxes. You're typically going to have more investment options, and hopefully somebody's managing it for you and managing it well. So required minimum distributions. So again, as Larry talked about, when you are 70 and a half, if you are lucky enough to have money in an account and you have enough income coming in that you don't need the money from your account, you don't need to pull it out per month or per year to live on, at 7 and a half, if it's pre-tax money, the IRS is saying, well, we've allowed you to not pay taxes on this money thus far. You are 70 and a half now. Start drawing out some money and paying us our taxes. All right? So that money that you have to pull out is taxed as income. So again, if you believe taxes will go up at some point, you're only increasing your tax burden. So there are certain types of accounts, which we will discuss, that you do not have to take required minimum distributions from, or the money that you pull out will be tax-free. Challenge number 4, expenses. Healthcare, that's a big one. We'll talk about that. The basics, basic living expenses. The extras like travel and gifts, and leaving a legacy. If you have children or grandchildren, or a church or charity, or maybe educational institution that you would like to leave a gift to upon your death, how do we prepare for that? So medical costs during retirement. This is a big one. Fidelity did a study that showed that a couple 65 that retires today, on average, will spend $280,000 in retirement on health care alone. That does not include long-term care costs. Let me hit on long-term care for a second. 91% between husband and wife. There is a 91% chance that at least one of you will need long-term care at some point in your life. 91%. If I was a betting man and I went to the casino, if there was a game there that I could play and have a 91% chance of pulling more money out, of winning more money than what I put in, I would play that all day long. So individually, there's about a 70% chance of you needing long-term care at some point in your life. Between husband and wife, it's a 91% chance. So I have seen otherwise good retirement plans be fairly, pretty much decimated by not having a good long-term care plan. So it is simply something that must be planned for. And I'll give you 2 quick stories. I have a friend that lives in South Florida. His wife's parents lived in Arizona. They needed long-term care. They didn't have a plan. They had to fly and go pack them up, move them home. They moved in with them. He gave up his home office, renovated it for them, spent $8,000 renovating their bathroom to make it accessible for them. They were both on oxygen and had different needs. So their monthly power bill went from $200 a month to $500 a month. His wife, who was a commercial real estate broker in South Florida, so you can imagine how much she made, basically quit working to help take care of them. He said that it was affecting her very negatively. He said that she was, he put it very tactfully, he said she was moody, kind of tough to be around sometimes. He said that she, it was affecting her very negatively. He said she was gaining weight. He said that his son actually came home from college to help his mom take care of them because he saw the effect that it was having on her. Now, they were there for about 1.5 years. They both died a couple weeks apart from each other. And so his wife, of course, was very sad that both of her parents just died. She, on the other hand, was very relieved that she could get back to living her life, and then felt guilty about feeling relieved, right? So it's not, the long-term care planning is not necessarily just for you, it's for everybody around you. And so one other personal story, my grandmother, my mom's mom, had dementia for the better part of a decade. She passed away a few years ago, so anybody that's had any experience with dementia or Alzheimer's knows that the first, part of it, the first handful of years is a pretty slow, gradual decline. The last couple of years are a pretty steep downhill decline. And it was up to my grandfather to help take care of her. We men are not great natural caretakers typically. My grandfather owned a business and was very type A and, thought he knew best. So he didn't necessarily follow doctor's orders on taking care of her or medicating her correctly. As most of the women in here, can I get an amen, that most of us men are hard-headed and don't listen? Yeah. So, he didn't do a wonderful job of helping taking care of her. He accidentally would keep her doped up half the time because if she said she needed more medication, he'd give it to her. He just kind of let her sit on the couch, literally sit on the couch and stare out the window all day. They have a son, my uncle, who's Down syndrome. So it was up to my grandfather to take care of, his name's Clayton, up to my grandfather to take care of Grandma and Clayton. And Grandma made Clayton sit on the couch with her all day and stare out the window too. So it was affecting him negatively as well. I have another uncle, their son, who lives 2 doors down. Literally, there's one house in between them. No help when it came to taking care of her. And then there's my mom and my aunt. So everybody lives right here. So anytime, Grandpa needed help with anything, needed to go run errands, Mom and my aunt would either run the errands for them or go sit with Grandma while Grandpa ran the errands. Point is that I think when it comes to long-term care planning, too many people focus on having some sort of plan that's going to pay for everything. Well, we don't know what that everything is. Everything might be, just custodial care for a couple hours a day. Everything might also be, round-the-clock skilled nursing care. So my point is they didn't have any kind of long-term care plan, and it would have been a real blessing if they would have had something that was small that just could have afforded for somebody to come by for a couple hours a day to help bathe Grandma or just be with her while Grandpa goes to run errands or whatever it is. So it's just important that it is prepared for in some manner. I'm not going to go over this. I think this is, these are all averages, which I don't like. Another way we looked at inflation, the Consumer Price Index. So in 2014, it took $181 to purchase what $100 would purchase in 1990. So again, inflation is eroding the value of our purchasing power. Another way to look at inflation, this looks at food, utilities, gasoline throughout the decades. So what about the extra? Again, we didn't retire to penny pinch. We didn't retire to sit at home. We retired to go out to eat, maybe go to Broadway shows, do some traveling, give gifts to grandkids, or charities, institutions, whatever it may be. Let me hit on one thing here. So when it comes to gifts for charities, whether it be your church, a charity, UWF, whatever it is, one of the best ways, and I think one of the ways that people don't know that you can utilize, did you know, so if you're giving, let's say, I've helped a lot of people do this with their church. Let's say that you tithe on average $500 a month to your church. If you took $300 a month of that and purchased some sort of permanent life insurance policy, if the charity or church or institution was the owner and the beneficiary of the policy and you were the insured and the payer, it keeps the same tax status. Your premiums are still tax deductible just like your gifts were. And let's say that $300 a month got you $100,000, $200,000 worth of death benefit. At what point of $300 a month, $3,600 a year, will you give that charity or institution $100,000 or $200,000? Probably not in your lifetime, right? So this is a way to maximize your gift to the cause, the charity, the church, the institution, the university that's important to you. Changes nothing. You're not giving any more money. You're still getting the same tax write-off, and you're guaranteeing that you're leaving that charity or institution a whole lot more than you ever would have given them that monthly gift, that monthly or annual gift. So, do you want to leave a legacy? Who would it be for? What's important to you? So just something to think about. I will say that people sometimes younger in their life, it may or may not be a big deal for them to leave money to somebody. I have some clients that are, kind of up there in age, and I'll meet with people sometimes, and they might have, $12,000 or $15,000 in a CD or in a bank account, and you ask them what this money's for, and they say, oh, well, that's for the grandkids. I want to make sure that that's safe. We can't do anything with that. So while it's not a whole lot of money, it's very important to them at that stage in their life to leave somebody something, and that's everything that they, can afford to give. So I just think that as you get later on in life, it becomes more and more important to you to leave somebody something. Sir? That's correct. Yep. So expectation versus reality. Again, there's a lot of things in our life that we assume will happen a certain way, and then there's a way that they actually happen. So retirement sometimes is one of those things when you're talking to people about how they think things will go versus how they actually go. So a lot of people think that they retire and their expenses will automatically, magically decrease. And while they will decrease some because you're not saving for retirement, there are certain other expenses that you may not have, but there are also other expenses that you didn't have before you retire. So if you're like most people, the day of the week that you spend the majority of your money is on a Saturday. When you're retired, every day is a Saturday, right? So most financial advisors will tell you kind of the rule of thumb, and again, everybody's situation is different, to factor in living on 75 to 80% of what your pre-retirement income is. So this is just another way to look at it. So how much can I withdraw from my retirement accounts? This is a big issue for a lot of people because again, we have to strike that balance. We want to make sure to not pull out too much because then we run the risk of outliving our money. We don't want to pull out too little because again, we didn't retire to penny pinch, we retired to enjoy it. So there's what's called the safe withdrawal rate. Has anybody here heard of the safe withdrawal rate? 4%. So that was created. That's been the rule of thumb since I think either 1992 or 1994. But that has been a rule of thumb for several decades now, and people are still using that. Now, that's based on a 50-50 portfolio, 50% stocks, 50% bonds, and that's assuming when you retire, you don't pull out more than 4% per year of what your portfolio value is at the time. Now, that gives you a 90-some-odd% chance of your money lasting for 30-something years. So it gives you a 90-something% chance of not outliving your money. Now, as Larry was talking about, in a plane in a thunderstorm, if you're going from here to New York on a plane, do you want a 94% chance of reaching your destination? Or do you want a 100% chance of reaching your destination? Okay, so point is that there are some flaws with the safe withdrawal rate. Interest rates in the 1990s were, when this was created, looked a whole lot different than they do now. And don't take my word for it. You can do a lot of research on it. But the new safe withdrawal rate, they say, recalculated for today's interest rates are more along the lines of 2.8%. So even lower than the 4%. But just based on the 4%, we're going to stick with 4% for today's purposes just to keep things simple. So they assume that if you have $1 million when you go to retire, pulling out 4% a year, you should be able to pull out $40,000 per year. And again, have a pretty good chance of not outliving your money. Now, what we are trying to do from our retirement income standpoint is guarantee the amount of income that you need in retirement and then leave the rest of your money discretionary. All right? Mailbox money. If you have enough money coming in per month that you can pay your bills and live the lifestyle that you want to live, well, then you are not worried about the money that you have still invested in the market because regardless of what the market does, I can pay bills. I can do what I need to do. Lifestyle's taken care of. So we're trying to guarantee the amount of income that you need per month or per year in retirement and then invest the rest and keep it discretionary. So for these purposes, let's assume that you have a $5,000 per month retirement income need. So let's say that between husband and wife, you're getting $3,000 per month in Social Security income. Let's say you have another $1,000 a month coming in from another source, such as a pension. That leaves a $1,000 gap. What's the best way to guarantee that $1,000 a month gap? So there's basically two methods. Option number one, we can use a safe withdrawal rate. Again, for these purposes, we're going to use 4%. So let's assume that you had $500,000 saved up and you need an extra $1,000 per month or $12,000 per year based on that 4%. So option number one, based on the 4% safe withdrawal rate, we need to earmark $300,000 of that money, invest it safely, and draw 4% of it to get us that extra $1,000 a month that we need. That would leave $200,000 of discretionary assets that you can invest maybe a little more aggressively than you otherwise would, because you know that we have this amount of money that's earmarked for that 4%. Now, if this money is still invested in the market, it's still going to go up and down. I don't care what percentage of stocks and bonds you have. Last year was the first year since 1969 that both the stock market and bond market ended the year negative. The only asset class that made money was cash, or unless you had money in something guaranteed like a bank account or CD or annuity or something like that. So you can still lose money by having your investments in bonds. So if this money you still have invested in the market and you're pulling out 4%, that $12,000 a year to meet that income need, while this money is discretionary, this money isn't truly discretionary. You're still going to lose some sleep, and you're still going to be a little worried about this. You're still going to invest it pretty conservatively, because in the back of your mind, you're going to go, well, I need to have this in case I need to kind of, pull some money from this to put over there, right? If this one gets too low, I need to pull money out of here to kind of make up the difference, right? So it doesn't allow you to truly be discretionary with that money. Option two, use a 6% payout rate. So you use some sort of income annuity. You earmark $200,000. $200,000 at a 6% payout rate would give you that $12,000 a year, $1,000 a month. That leaves $300,000 truly discretionary, because regardless of what the market or economy does, this is going to give you, this $200,000 that you earmarked at this 6% is going to give you that $1,000 a month, regardless of what happens with the stock market or economy. That truly leaves that $300,000 discretionary that you can invest a little more aggressively than you otherwise would have, and you're not going to lose any sleep over if you see it go up and down. Now, I will say, some people I've heard say, well, if a person is talking to you about annuity, they're just trying to sell you a product to make a commission. Now, I manage money as well. I'm a fee-based financial advisor. I charge for advice, and I charge to manage people's money. Now, if I'm charging you 1% on your $500,000, would it make more sense for me to keep that money invested that I'm going to be getting paid 1% a year on forever, ever, or take $200,000 of that, put it in an annuity that I'm going to get paid a 2 or 3% commission on one time and never get paid on it again? Which one makes more sense for me? To leave it in the managed money, charge you 1% a year for as long as that money's in there. Why would I give up 1% a year on $200,000 forever to get paid a 2 or 3% commission on it one time and never get paid on it again? So I will say that there are types of annuities out there that are very high commission products that are overly complicated and sold as something they're not, that I don't sell. So there are problems. So when people say annuities are evil or whatever it is that people say, there's tons of different types of annuities. If you've ever had a piece of crap car, you didn't stop buying cars. That car was just a clunker, right? You went and found a better car. You didn't just write off cars altogether. So there are types of annuities that I personally do not sell. But again, I just wanted to make sure that people understand when people say, if somebody's talking to you about annuity, they're just trying to sell you something. It's not in my best interest to sell you an annuity, but depending on the situation, it may be in yours. So that's what I'm a fiduciary. So I have a legal obligation to make sure that whatever it is I'm doing for clients is in their best interest. Yes, sir. This presentation actually will be. Mm-hmm. Yes, sir. Yep, and so you want to make sure, again, like I talked about with the pension, with the annuity, you want to make sure that it is both you and your spouse, that you have it on there for your joint annuitants. You can. Yeah, that's right. So if you wanted it to, I'm sorry. the 4% is based on the amount at the beginning of your retirement. So with $1 million, you're pulling out 4% a year. You're pulling out $40,000 a year. So it's not right. Go ahead.
I don't know, oh good, I'm on now. Absolutely 100%. This just gives you another option. I agree with you that, again, if you were to buy it's like getting a bond or a pension. If you retire, how many people here are working here at UWF? Let me see a show of hands. Okay, how many people are in the state of Florida pension plan? Okay, so when you all retire, the state of Florida is going to say, okay, we're going to pay you X for life. I don't think that's indexed. I think it's correct? But let's go, for those of you who are in the defined benefit plan, you're going to get that. It's X that you're going to get.
It does get a cost of living.
So it does. Okay. So with that, though, there's a cost. In other words, if you get a level, it doesn't come out of the air. It's got to come from somewhere. I agree with you. The 3% that you're going to get would be more expensive, or you'll need more of an upfront amount of money, or the state has to have more money up front to provide that for you. And it's great that you're going to get that, and you're going to get an increasing flow. And there's no question about it, is that inflation, as this gentleman spoke about before, is going to eat up that money. The whole reason why, and Andrew and I have talked about this, and this is something my wife and I have done when we set this up, we want to make sure that we're going to get a set pension for life. That way we can leave money in the market and not have to worry that, oh my God, the market's down 10%, okay? We know that our basics are going to be covered even with this going on in the market, and that's the thing. So, I'm sorry? No question. That's what, agreed. That's why you want to have money in the market.
But yeah, I was just going to say both options are going to have their pros and cons. Now, people ladder annuities sometimes. In other words, they'll have one that starts paying out at 60, and then at 65 or 70, and so on, to give them that cost of living increase. And it just depends. So again, and I'm not trying to. I don't. Again, whether you leave that money invested or whether you put it in an annuity, it doesn't matter to me either way. I'm here to help clients. But point is that one version is a completely risk-free version. One version is going to carry some amount of risk. So it really just depends. Again, that's why we, all these plans are tailored specifically to the individual because some people are more comfortable with more risk than others.
If I can just chime in.
Please.
And here's the thing, for those of you who are with the university and have the defined benefit plan from the state of Florida, you're blessed. Most folks, okay, don't have that anymore. And so if you have this, great. Say thank you, Tallahassee, and you put your time, no, great, and you put your time in, and that's wonderful. Most folks don't have that. In fact, I'm probably one of the few folks left, as I said, I just turned 60, that I actually have, for Marcy and me, a defined benefit plan. For folks who are younger than probably 50, 55, that's gone. And you, Owen, right? And you mentioned that the state doesn't have the same animal anymore. It's gone. Because again, it's so expensive that it's become unaffordable. So you got all the great stuff. Don't let anybody take that away from you. But not everybody has that. And this is why, and again, we're being generic, just saying, here's things, here's black and here's white. It's all gray. So that's the thing. We're not poo-pooing it. You got all the good stuff. I'm sorry, Andrew, go ahead.
No, and that's a very good point. And again, that's why we tailor plans based on the individual. And to Larry's point, not everybody has a pension. So for people that don't have a pension that want to increase their guaranteed income, that's the way to do it. And again, you would never take that full $500,000 and annuitize it, because then that leaves you no discretionary assets. That's why you create some sort of guarantee for yourself. You leave the other money invested to hopefully outpace inflation, right? But and again, there's tons of different ways that you can do that. Any other questions? That was a good question. Yes, sir. So cash like money markets or things like that, I mean, it was like 1 point something percent. So it's not like, they didn't. Right. They didn't lose, right? So, yeah, it was just one of those one-off years to where if you had money in the market at all, stocks or bonds or whatever, unless you just so happened to have all of your portfolio in just a handful full of stocks, which is ill-advised, and those handful of stocks just so happened to do well, then you made out. Or unless you had some money in something fixed like, CDs or cash or fixed annuities or something like that. That's right. Yeah. So, Social Security. Who in here knew that your Social Security can be taxed? All right, so married filing jointly, if you claim over $44,000 a year, 85% of your Social Security is taxed as income. Married filing jointly, 0 to 32,000. If you have an income of 0 to 32,000, none of your Social Security is taxed. 32 to 44,000, 50% is taxed. Anything over 44,000, 85% of your Social Security is taxed as income. As an extra jab to the side, half of your Social Security benefit counts towards your income calculation. So in other words, if between husband and wife you're getting $40,000 a year in Social Security benefit, your income is already $20,000 before you get any income from anywhere else. So in that instance, so let's say husband and wife, you had $20,000 a year coming in Social Security, or excuse me, you had $40,000 a year coming in Social Security. $20,000 already counts towards your income. If you pulled another $2,000 a month, if you had $2,000 a month coming in from pension, $2,000 a month from your retirement account, like a traditional IRA or 401k, something that is taxed as income, that puts you in that $44,000 bracket, and 85% of your Social Security is taxed as income. So it behooves you to keep your taxes as low as possible, to keep your income as far as reportable low as possible in retirement. Well, they're still individual. I just don't know them off the top of my head. But they're still, individually, you still have thresholds. Mm-hmm. Mm-hmm. Yeah, I mean, you can get creative with it potentially depending on the situation. Yes, ma'am. 0 to 32,000, 0% is taxed. 32 to 44,000, 50% is taxed. Anything over 44,000, 85% is taxed. And again, half of your Social Security benefit counts towards that income calculation. That's right. Mm-hmm. Yep. All right, so let's talk about solutions because that's what we're all here for, right? Not just to talk about the problems. So number one, optimize investment portfolio. Number two, minimize income taxes, like we're going to talk about. Number three, plan for extended periods of care not covered by medical insurance. So like we talked about, long-term care. Consider guaranteed income for life. Again, all we're trying to do is guarantee the amount of income that you need. If you had income coming in from pension and Social Securities that gave you the amount of income that you needed, then an annuity would not be, that would be foolish to do. So you would just, leave your money discretionary and invested. Number five, consider other sources of retirement income. Some people, like to get into investment properties. Some people will find little part-time jobs that they like doing just to make extra income and keep them busy. So those are some other sources to consider. So optimize your investment portfolio before and after retirement. So again, rules of thumb. And these rules of thumb, again, we tailor to people's individual circumstances. But rule of thumb is 5 years before you retire, you start dialing down how aggressive you have your portfolio. Because what you wouldn't want to do is if you left your portfolio aggressive and a year or two before you retire, we have another 2008, right? Because you don't have enough time to recover it before you need to start taking money out. And then also after retirement, leaving it somewhat conservative. And it, again, depends on a lot of things, but leaving it relatively conservative your first handful of years in retirement might make sense. there's a lot of things. So who in here thinks that we might have a recession within the next 2 years? All right, so if you're worried about recession, and again, last year was the first year since 1969 that both the stock market and bond market ended the year in the negative. So regardless of if you had money in stocks or bonds, you probably saw a loss. So again, a common misconception that people have is bonds are safer, and they are safer than stocks, but people assume that you can't lose money in bonds, and that's not true because bonds work inversely to the interest rates. So when interest rates start going up, the value of bonds start going down. So we'll talk further about investment portfolio here in just a moment, but it's important that you understand the risk profile of your portfolio. So I'll give you an example. If you said, well, I have a 60-40 portfolio, 60% stocks, 40% bonds. Well, let's say portfolio A was a 60-40 portfolio, but the 60% in stocks were in things like technology stocks, emerging market stocks, things that are very volatile and very risky. And the 40% was in things like high-yield corporate bonds. High-yield corporate bonds used to be called junk bonds. Junk bonds is not a very marketable name. High-yield bonds are much more marketable. So they are indeed the same thing. They just have been renamed to something that is more marketable. Point is that high-yield corporate bonds, you can see a higher return, but they are more risky. So in other words, a 60-40 portfolio of technology stocks and emerging market stocks and high-yield corporate bonds is going to have a completely different risk profile than portfolio B, where the 60% in stocks are in things like blue chip dividend-paying stocks, utility stocks, things like that. And then the 40% of bonds are things like treasuries, very high-grade corporate debt, things like that. So they're both 60-40 portfolios, but they're going to have completely different risk profiles. So not only is it important to understand what percentage you have and what types of assets, but also what the risk profile of those assets are. Make sure that they match your investment objectives and risk tolerance and so on. Avoid lump sum distributions. I'm sure I don't have to say this, but don't cash out your retirement accounts. You will pay taxes as income for that year, and if you're younger than age 59 and a half, you will pay an extra 10% government penalty. So I got a referral from a client several years ago who just retired, and I called him, and he could tell he didn't really want to talk to me, and that was fine. But he had just retired, and he was saying that he took his 401k and his pension lump sum and put it in the bank. So I'm trying to tactfully find out, well, did you put it in an IRA with the bank? He said, no, I put it in the savings account. And I said, well, you can put a savings account in an IRA. So did you put it in a savings account within an IRA in the bank? And he was getting irritated with my questioning, so we got off the phone. I said, do you mind if I call you in 6 months just to see if anything's changed? He said, sure. So I called him in 6 months. He was terribly upset because he just had to write a 6-figure check to the IRS because he did not realize that if you're going to move that money, you have to do it a certain way. So let's avoid that if we can, shall we? Minimize your income taxes. So as Larry alluded to, tax-free municipal bonds are federally income tax-free. However, they do count towards your income calculation when it comes to Social Security. Long-term capital gains as opposed to short-term capital gains. Short-term capital gains are typically taxed as income. So short-term is anything less than a year. Long-term capital gains are anything over a year, as far as long as how long you hold that investment before you realize that gain. Any long-term capital gains for most people are taxed at 15%. If you're in a very high income tax bracket, it's taxed at 20%. And then things like cash value out of life insurance or money out of a Roth IRA is not taxed as income. I don't know if we're going to make it. So consider that people are living longer, and that means that you need to make your money last longer, but living longer also complicates health situations. So chronic health conditions. Percentage of people over the age of 65 that have 2 or more chronic conditions. So the blue bars show you from 1999 to 2000 what percentage of women, men, and total between women and men had 2 or more chronic conditions. The orange bar is 10 years later. So a pretty substantial increase in people that have 2 or more chronic conditions. So again, leaving behind a spouse. If you have a pension, it's very important to understand the survivorship option that you have on your pension. It's very important to understand that if you are married, and one of you passes away, the survivor gets to keep the higher of the two Social Securities, but not both. So there will be a drop in income there. If you do have an annuity, again, make sure you understand and you have some sort of joint annuity where both you and your spouse, the income will last for as long as you both live. So again, people working longer. So in 1991, 11% of people expected to work after 65. In 2015, 36% of people expect to live past work past 65. That could be a number of different reasons. That could be because people know that we're living longer and need to make our money last longer. That could be because people aren't as financially prepared. Longevity risk. So this shows you the probability of a healthy 65-year-old living to various ages. So you can see age 80, between husband and wife, there's an 88% chance that at least one of you will live to 80. Between husband and wife, there's at least a 45% chance that one of you will live to age 90. So again, while that is beautiful and wonderful, that is a long time to make our money last. So this is a New York Life presentation. So they're going to talk about New York Life annuities. We can write annuities through whoever if that ends up being what you need it to do, or part of what you need to be part of your plan. So different companies do certain types of annuities better. So if we decided that you needed this type of annuity for whatever reason, and we found out that company XYZ did it the best, we would do it through company XYZ. I will say, however, that as far as companies go, when it comes to fixed annuities and income annuities, New York Life owns over a third of the market share for those products. So for one company to own over a third of the market share of any one product is pretty impressive. I think the next highest competitor has like 9 or 11% or something like that. So what about CDs? Advantages, disadvantages. Interest rates are fixed, income is dependable, and it's FDIC insured. Disadvantages, you're probably not making a whole lot on it right now, and the income is taxable and could affect your Social Security. I'm sorry if you feel like I'm rushing through this. I'm being timed back there. So permanent life insurance, again, that could be for people it's very important to leave a legacy. So in other words, leave money to kids or grandkids or an institution. And again, there are planned, some creative planned giving strategies that you can do, like the one I shared earlier, to kind of maximize your dollar and get the tax advantages that it gives you. So again, if you were to leave a legacy, who would it be for? So things to watch. This is a slide that I update based on just kind of what's going on in the economy. So I update it before every presentation that I give. So just a couple things that I think are going on right now that I want to make sure to hit on. Low employment. Low employment is wonderful. Low employment is at historic lows for a lot of categories. While that is wonderful and while that means that the labor market is strong, that means that there's not a whole lot of people to hire. So that means a lot of people are working, and that means if companies want to find and hire talent and keep talent, they're going to have to, quote, pay up. So you're going to see a rise in wages. So a rise in wages, also a good thing, but that could also cause a rise in inflation. If inflation starts taking off, which we're already seeing signs that it is starting to tick up, if inflation starts taking off, that will force the Federal Reserve to increase interest rates quicker than they otherwise might have. If they increase interest rates too quickly, that could cause an inverted yield curve. What that means is the yield on a 2-year treasury would be higher than the yield on a 2-year treasury would be higher than a 10-year treasury. That results in an inverted yield curve. What that means, an inverted yield curve has almost always been a negative omen for the economy and almost always resulted in a recession. Now, the lead time from the time a yield curve inverts to a recession historically has been anywhere between 5 and 24 months. So it's not like yield curve inverts and the next day we're in a recession. We have time. So if that happens, it's not time for panicked selling. It's time to your investment portfolio. If you're concerned about a economic recession, and if you're concerned about inflation, a couple things to consider. So if you're wanting to be safe, you need to look for high quality stocks and high quality bonds. If you're looking for high quality bonds but worried about inflation, there's what's called TIPS, Treasury Inflation Protected Securities. They're not inflation sensitive, so that might be something to look at. Strong dollar. Most people think that a strong dollar is always positive. While there are a lot of positive things that come with a strong dollar, there are also negative things that come with a strong dollar. So it does affect import-export. So if it costs China, let's say, because their currency is weak compared to the dollar, then they won't be able to import as much of our goods as if their currency was stronger compared to our dollar, right? So that means that we're not exporting as much if our dollar is strong compared to other currencies. Bonds and rising interest rates. Again, bonds work inversely to the interest rates. So when interest rates go up, the value of bonds go down. One thing to look at if you are concerned about interest rates going up and you want to keep your portfolio safe and invest in bonds, floating rate bonds are non-interest rate sensitive. So that might be something to look at. Now, we are also seeing, people also need to understand that the stock market and economy do not necessarily move in tandem. So, the stock market can be doing well while the economy is not, or vice versa. So we are starting to see a lot of negative economic data, like housing data, auto sales, things like that, a lot of negative corporate data. There's a lot of things, a lot of data. All we can do is consider the data and digest it as it comes in. We are starting to see some negative economic data that leads us to believe that we are starting to kind of go on the downhill slide when it comes to the economic cycle. So again, we just need to be positioned correctly. So if you are worried about some sort of economic recession, if you're worried about your portfolio, if you want to leave it invested in the market, it may be time to take a more defensive approach. So during recessions, I'm not giving any recommendations, but during recessions, typically stocks of companies that are cash rich and don't hold a lot of debt will typically fare better than companies that don't hold a lot of cash and have a lot of debt. Also, it might be a good time to look for what's called non-correlated assets. So in other words, assets that don't necessarily move in tandem with the broader stock market. So typically things like commodities, utilities, healthcare, maybe consumer staples, things like that tend to fare better during recessions than other types of stocks. Also, again, for the part of your portfolio that is in bonds, looking for very high quality bonds, just like we're looking for high quality stocks. So that means, potentially, reducing any holdings you have in high yield corporate bonds. If you're worried about, if you wanted to get into, higher quality debt, treasuries, very high quality corporate debt as well. If you're worried about inflation, again, TIPS, Treasury Inflation Protection Securities, are not inflation sensitive. If you're worried about interest rates going up, floating rate bonds are not interest rate sensitive. So just things to consider. And again, your portfolio, the mix of stocks and bonds, and what types of stocks and bonds should be something that is discussed with your financial advisor or investment professional or whoever it is that's helping you with that, to make sure that you are getting paid for the risk that you are taking. That's a very important distinction too, because sometimes people's portfolio is, might have an above average risk level and have an average return level. So you are not getting paid for the risk that you're taking. So it's important that your portfolio matches your risk tolerance, matches your objectives. You need to make sure that it's efficient and you're getting paid for the risk that you are taking, whatever level that is. And so there are things that we can prepare for. This is the last thing I promise. There are things that we can prepare for and things that we cannot. So December, of course, the stock market, last quarter the stock market suffered, December in particular. There wasn't any real fundamental, data. There wasn't any real fundamental reasons for that doing that. It was just people's fears. So while we can't necessarily prepare for market gyrations, we can prepare for, bigger economic moves. We can look at, lead economic indicators and kind of digest the data as it comes in, and prepare our clients accordingly, as you should do. But again, The market moves. The market is the average investor at any given time. It's the mood of the average investor at any given time. So, there are certain market gyrations and volatility. There's not a whole lot you can do to prepare for, but hopefully you can prepare for and mitigate against any bigger risks. So with that, we will end and we'll take questions. I will say the folders that you have in front of you has a lot of information. Take that home, read it, digest it. One thing that we ask you to do, there's a seminar survey in the back. It's just a compliance thing, if nothing else. So it's in the back of the right hand of the folder, right-hand side of the folder. If nothing else, just write your name on it. If you feel led, if you would like to give us some feedback and just say, this is what you did well, this is what you could improve on, leave us feedback. We're always trying to get better. Also, if you want us to reach out to you about anything in particular, feel free to leave your name and contact information. You don't have to do that, but just from a compliance standpoint, we do just need you to write your name and leave it here. So you don't have to include any other information if you don't want to. But with that, we'll open it up for questions for both me and Larry. Yes, sir. Okay.
I'm heavily invested in Maygarden Center.
Mm-hmm.
It has a fund manager. It's 40% stock, 60% bond. I assume that this fund, and apparently quality investments, is able for most of the recession. I assume that I'm fairly well looked after by someone that's A, looking for quality, B, staying on top of the market, and of course charging low fees. Am I naive?
I just will say, so Vanguard, so I was just talking to somebody this morning about this. The index investing, so in other words, and Vanguard does a lot of that. And while taking nothing away from Vanguard, I'm not picking on Vanguard, I'm just picking on index investing. And not saying there's not a place for index investing. But I have some clients just the other day that both of them, have their IRAs, and it's all invested in an S&P 500 index fund. And the husband, who's the one that's, managing it, or at least kind of making the decisions, said, well, it should be safer, right? It's the index fund. And I said, it's all stocks. It's 100% stocks. In 2008, there was a negative 37%. It ended the year negative 37%. At one point, it dipped under 50%. In the early 2000s, there was 3 straight years of losses, negative 9, negative 11, and negative 22. In the S&P 500, which is what you're invested in. And I said, when you're purchasing an index fund, you're buying a piece of all of those stocks, all of the 500 companies in the S&P 500. If you were to go through, if you knew what you were looking for, and hand-picking companies, there is inevitably a certain percentage of those 500 companies that you would not pick if you were picking them by merit. Right? So you get all these people that's investing in the S&P 500 index. So all this money being invested is going into all 500 company stocks and lifting them all. So during a recession, it will separate the wheat from the chaff. And so the companies that you would invest in based on merit, will rise to the top. The ones that people are, the ones that the stocks have been doing well just because everybody's investing in them will be separated from the wheat. Makes sense? So I just will say, look at the underlying investments in that particular fund, and just make sure that if you were to go out and hand pick these investments yourself, that they match what you would hand pick. I love Vanguard. I'm just be conscious of what that fund is invested in.
And the other thing I would add, and studies have shown that if you have between 2 and 3 years worth of expenses, that income set aside, you can withstand the gyrations. So again, if you have that and then you continually will roll that from your portfolio so you maintain that amount in cash, you should be okay. But again, that's an average. You know what they say about an average. If your feet are in the freezer and your head's in the oven, your average temperature is 70 degrees, but you're in trouble either way. So, you guys, they laughed in New York about this. Come on.
And to Larry's point, I make that same point with people. So if you had $100,000 and you saw a 100% gain this year, you now have $200,000. Then if you realized a 50% loss,
right,
you're back down to $100,000, but your average return is 25%. Your real return is 0.
Exactly.
So there's a difference between real return and average return.
Thank you. Please.
Having 3 years of draw set aside in a money market account,
Exactly right.
Right.
Yeah, that could, that would,
Well, let's just say this, because I know we're recorded. Again, we're giving generic information. Everybody's different. You know, again, they have doctors on TV, but they aren't practicing medicine over the internet. In other words, so all we're saying is, again, it's kind of a generic answer. Someone may want to have 4 years. Someone may want to have 2 years, and that may be okay. The key is just to make sure that you have what you need and for your family to be able to sleep at night. Because, again, if you're losing 1 minute's worth of sleep, your portfolio isn't set right. I got a call, you're smiling, you understand what I'm talking about. I got a call from another friend of mine. He's got a client up in the Northeast. He sold $1 million worth of securities, I think on December 20th.
right
He
before
said, I
bottom.
couldn't take it anymore. And he pretty much hit the bottom. He's furious now, okay? And this gentleman has multiple times that in wealth, but his stomach was churning. So again, Andrew talked about it. This is why you want to have alternative asset classes. And again, we talked about this. It's not your assets that you spend, it's your income. So if you have the income that you know that you can ride through the storm, you're going to be okay. So thank you.
Eric, Andrew, thank you very much for your time.
Thank you.